advantage here is, can you buy it at a low enough value that it becomes difficult to compete?
Do you think the total number of RVs per capita in this area is going to go up or down for the next 10 years?
Why on earth would you pay $3 million for a loan in Waxahachie, Texas on some shitty gravel lot with some tin buildings on it?
Hi, welcome to this week's episode of Real Estate Anonymous. We are going to go back to the well a little bit here with an outdoor storage facility in Midlothian, outdoor storage facility, not to be confused with an adult toy storage facility, or the same acronym, in Midlothian, Texas, which is south of Dallas, north of Waco. And we're going to kind of talk about some of the fundamentals of the outdoor storage industry again. We're also going to bring up a dynamic of assumable debt, which is important today. But the one really important thing is debt does amortize after some period of time, and that's important. We're also going to bring up some creative value add strategies for the outdoor storage industry, which are going to include tiki bars and bringing in alligators, not the Florida gators that got beat pretty badly down in Austin last weekend. Hope you guys enjoy.
Welcome in another edition of the Real Estate Anonymous podcast. Elliott White, joined by Brett Moss and Eric Weatherholtz, as always. And we have a special guest joining us from the West Coast, Adam Deermount, who's going to be talking to us about some janky ass outdoor storage thing he's got going on, something in Texas he's going to try and convince us to buy. And before we get into that, we'll kind of go around the horn. For those of you who aren't watching, so for the two of you who are listening, Eric is in a parking lot in a van. It kind of looks like perhaps the beginning of that movie Deliverance. And I want to first, can you just reassure everyone you're good and you're happy and healthy and you're there of your own free will?
I just blinked twice.
Okay, good.
Good.
So you might be living in a van down by the river with Chris Farley from the SNL skit, which would be cool. That would be A-okay with me.
So Eric is phoning in from the road. Brett, we're a little curious what's going on in your world. You got any new developments over the last week?
I would say it's gotten a lot more confusing. I think always when there's a presidential election, there's kind of a wait and see approach. I don't think that really matters at the end of the day, but it seems like there's a lot of volatility out there. So I think figuring out what the number is or what anything is worth right now in any asset class is pretty challenging.
You having fun with interest rates?
I mean, they kind of matter to values, I guess. I don't know. The emails come in from our trading desk and I just delete them and just pretend like I didn't see them. So that's helped with valuing deals.
I talked to a broker yesterday who said, perhaps I should have done a better job of understanding the impact of interest rates on value. I was like, yeah, you should have. That'd be a good thing for you to know. I was a little bit more diplomatic in my response. This week I had a new broker who I was on the phone with, and I think it's perhaps because he's used to talking to general idiots instead of specific idiots. And he was explaining to me, we were talking about operating costs, and he was like, well, here's how much it costs to, you turn a unit and the tenant moves out and you've got to send someone in they have to fix the place up and clean it. And I was like, I'm going to stop you right there, man. I appreciate you explaining the basics of how apartment turnovers work to me, but let's assume I didn't make a $50 million offer because I'm just a who doesn't know what he's doing. And you could see he was young and he started like immediately backpedal, like he thought he defended me. And I was like, it's fine, but this is a bad use of everyone's time.
And you're an equal opportunity offender, Elliott, for brokers.
I will harass everyone.
To know that.
Yeah.
Right.
Yeah.
Okay.
It's actually known to the point where brokers I'll be talking to them and they'll start giving me the pitch and they'll stop and they go, look, man, I don't want this to end up on Twitter. All right. I'm like, well, depends on how pitch is going to be.
Close your mouth.
Yeah. Right. So been a good week for us. Eric, you're obviously on the road, but eventful week for you. Anything new going
on? Some excitement. We two things. We learned that got a project that's under construction. These development deals are 3+ year opuses, and we're within 75 days of completion. Been through the long winding gritty road of building some buildings, and the power company let us know that they've lost our transformers. The lead time on transformers is about 18 months. And so the ones that we have been planning on to put in 75 days have gone missing with some sort of loose reference to the hurricane. So that's been an exciting feature for the week. The other thing, I was talking with, so we have had this election, and I was just cracking up with somebody that people making a comment that, that a political outsider, and I don't want to get into a political discussion, but turning it back towards real estate, that a political outsider could be effective in this, in the world of getting elected. And we were just cracking up. If you're somebody if you're a real estate tour with 60, I don't know how old he is, but say you've been doing this for 60 years, the amount of that you have been able to convey and use to influence people and talk smack to brokers, lenders, cities, every person in the ecosystem with 60 years of reps, I've got to believe that politics is low-hanging fruit.
Yeah, I think that's
a fair assumption.
That's probably fair. As someone who's on their way to fly to Florida to meet with some government officials, I'd like to think that after 60 years of getting in these reps, perhaps I will be in that position. Eric, what I love the most about your video is that it's like grainy, like Adam and Brett are in high def and you're clearly on the road. And it's almost like a video from like an old relative from back in the 70s who's like recorded something that they now want me to hear.
It's kind of ethereal. Yeah, I get it.
It's great. Yeah, I'm like, wow, Eric, good for you to be back with us. So we're going to pivot to the guest of honor here. Adam, you want to tell people a little bit about who you are, what you do, and before you try and pitch us this collection of sheds on some dirt, give people a rundown, like how do they get in touch with you? What are you doing? And that kind of fun stuff.
Sure. Adam Deermount, portfolio manager at a debt fund out here in California called Nichols Mortgage Fund. We do loans 5 to 40 million, all construction, bridge, value add, California only, product agnostic, type of stuff we do. We've got 4 in closing right now. Brand new build, multifamily over retail, kind of Main and La Jolla, some value add industrial up at Santa Clarita, just sold a brand new build industrial to a Fortune 500, one of our borrowers did out in Riverside. And the vehicle's a permanent capital vehicle. It started 17 years ago. Friends of mine started it up, Don and Carrie Nichols, and grew it from a few $1 million to about $160 million in equity today. Hasn't had a default in a long time. The first thing I did when I started earlier this year was I got to file the first NOD in the history of the fund, which was kind of fun. But it's been busy. I think, had a little bit of a false start with Fed cuts. Little was it known that that would actually make the long end of the curve go up, which certainly threw people for a curve.
How happy are you that you don't have much exposure to syndicators of Sunbelt multifamily?
Yeah, happy doesn't begin to describe it. Fortunately, we've got a little bit of exposure to LA at some of the rent control shenanigans up there, but much better position than your Yahoo that was out syndicating in Vegas and Phoenix.
My favorite part about talking to the multifamily debt funds is each one of them goes, "Oh, our loans are good, but those other guys are like, look, guy, I've seen your loans too. You're not doing so great."
All right, here
I
I want to stop the tape. We've sort of built a brand around this podcast as being by dumb guys for dumb guys, and we're really going to get it's sort of a core feature of the thing, but yet today Adam sort of glossed over this. We have with us a professor,
a smart guy.
We got a smart guy. We got a professor of real estate. So just be prepared for the three of us to get pantsed as we go through this when we hear what the professor has. Another fun fact about Mr. Deermount, an all-American sailor. How many of those do you know?
Adam, I hope you brought along some crayons so you can explain the hard concepts to the three of us.
Yeah, Elliott, I actually went to school, your neck of the woods, graduated from Tufts like 25 years ago. So
Tufts is a great program. Boston's a fun city.
Yeah, it is. It's a blast. Eric, appreciate the kind words. I don't know. I fooled UCI into thinking that I know what I'm talking about.
So how does that actually work? How often do you do that?
Yeah, so it's once a week for a 10-week period, and it's a 7 to 10 o'clock class. So all grad students, some full-time, some executive or FEMBA fully employed. It's a short class. I mean, we're already almost done with it for the fall quarter, for the fall quarter, but usually have guest speakers. I actually, there are two podcasts that I told everybody that they have to listen to. One is Trepwire, because it's a real estate capital markets class. And then the other is this one. And part of the reason why, and this was long before I knew I was going to be on here, but their final project, we don't do an exam. We do a final project where they have to pick a real estate project. We put together teams, and then they have to pitch it. And the guest speakers during the quarter act as the investment committee. So they've got to identify a project, come up with a business plan, come up with a financing plan, and then pitch all of us on how they're going to execute it.
Well, let's get the winner. Let's bring the winner on here and see if he can convince three boobs to do something. Yeah, I like it.
Yeah, that sounds like fun. Let me see where they shake out. It could be a little hit or miss. Last year was really good. The year before wasn't as good.
Well, I didn't know that we were in charge of shaping young minds, but I'm glad you've encouraged them to listen to this collection of nonsense. Let's jump into this deal that you've got for us. Would be curious what you think of it, why you like it. Maybe you can introduce the overall property a little bit, and then we'll kind of chop it up.
Sure. So just as a quick background, before I went over to the dark side lending, I was CIO at an RV and boat storage, industrial outdoor storage company out here in Newport Beach called RDC, Ramsar Development Company. And we had a lot of several RV and boat storage assets in California, as well as a couple in Florida. Brett, I think you mentioned on the one that Andrew was on, Bob's adult toy storage. We actually bought that. It was partnered with Scott Ramsar, who's kind of an OG in that space. And this came across my desk because we were looking at some projects in Texas. And in this space, I mean, it's not the most sophisticated corner of the world. You had a lot of people that looked at trends during COVID and said, okay, this RV buying environment, boat buying environment is going to stay this way forever. And syndicated a bunch of money and built accordingly. And that's a little bit what you have here, where CBRE brought this deal out. And if you scratch under the surface a little bit, you kind of find that this is something that is a sell what you can mode, for a developer that, at least as far as I can tell, is pretty clearly over their skis. 30 different properties, mostly in and around the Dallas-Fort Worth area, the MSA, some outside of there, some like this that are completed, some that are still being built out, some that are in lease up, but a lot of floating rate debt exposure. And this one just happens to have a 4.6, I think, percent assumable CMBS loan, which makes it a little bit more attractive. Now, Midlothian, Waxahachie, you look at this thing, it just looks like some red roofs on sheds in the middle of a field. You do have quite a bit of population growth out here. If you look at, I think it was slide.
Yeah, so you're about a half hour south. Is that right? Yeah, about a half hour.
Real quick here. If this is the best picture you can come up with to cover, I think with some of the graphic support out there, you could probably make this look a little bit more occupied. But this is, I guess, leading me to believe this is the best picture they can have.
And when you're getting to the challenge of underwriting a deal like this, I think you hit the nail on the head, which is, okay, this thing's been open for a long time. I think this one was built, the original portion of it was built back in like the early 2000s, mid 2000s. And then there was an expansion the last few years, but they're sitting at, 75% occupied. And the sale pitch on this is they're self-managing, their marketing budget is kind of a joke, their website's janky. But, I think a lot of people got fooled in, call it 2021, on this vehicle storage concept that you could consistently achieve, mid 90s, low 90s occupancy. And I just don't think that's reality. And if you look at where the assumable loan is, I think the broker had this priced at $10.2 million. That's like 73% loan to value. And the debt yield there, 8.2, not exactly spectacular for this kind of product. So I think it's something being, one, realistic on a marketing budget, which in my opinion in this package, they're not at $3,000 a year. And then also being realistic on where stabilized occupancy is.
This is really hurtful to hear as the broker on this call. Another insinuation that brokers are maybe not based in reality, which is just heartbreaking.
Smart fellow like yourself, you'll turn this thing around in no time.
Yeah. Brent, I hate to pile on more here with the broker, but if you look at the page that's up right now, that page 22, again, a little bit of digging. The broker is showing this annual payment as an interest-only loan, and this loan actually is a 30-year amortizing loan.
What's a little bit of principle
details
among friends?
Yeah, details. Yeah, unless you want to pay down the loan balance, why would you want to do that?
Yeah, unless the CMBS servicer.
It's an add back to yield.
Yeah. I've seen that one as well. I mean, I've heard the CMBS folks are notoriously easy to work with, so maybe they allow you to
super understanding group. Yeah, they're very chill.
Very chill.
What I like, and I bet you're seeing negative trade outs here, is the assumption that you're going to increase top line. Oh no, that's an NOI. You're going to increase NOI 15% from year 1 to 2 by wanting it more and trying harder and caring more. I think. Is that about right?
Yeah, that's about right. I think that's the selling the dream part of this. I think that with a proper marketing budget, meaning more in the range of 15,000 than the 3,000 that the broker's showing in here, that you could increase the top line a bit. I think in here you're probably looking at topping out between 80 and 85% occupancy. You're at 76 now. But I think the bottom line is going to be challenged because their payroll's low. their marketing's low.
What's the sweet spot for occupancy on this kind of stuff? Like, where do you think you're going to be?
Yeah, this one, I think if you got to 85% here, that you'd be pretty happy with it. In some markets, like with RDC, they've got infill LA, infill Orange County stuff that's, was either long-term ground leases or, some sort of story as to how they got to it, because this is rarely the highest and best use for an infill location. I'd actually say never. You can manage well above 90%, but in this location, it's 80, 85%.
Yeah, and there's plenty of land. For those who don't know, so Midlothian is about a half hour south of Dallas, and it's actually kind of in between Dallas and Fort Worth. So you're pretty proximate to either. There's been some recent development south. Historically, North Dallas is where you wanted to live. Up in just the North Dallas suburbs are beautiful, but you start getting up into Richmond and Plano and some of these other places, and your commute into downtown is over an hour. And so a lot of people moving in from out of state have thought, well, that, I'll just live south. I can be 20 minutes south and my commute gets much easier. So there's been some bit of development down here, but it's not overly built up. I mean, if you do a halfway decent job here, as Eric likes to point out, what's to stop some other group from taking the field next to you and kicking you right back down the hill?
Yep. One thing that I think is interesting here that makes this relatively attractive is you're buying this. Let's say I don't think you'd pay 10.2 for this. No way. But at a certain point, you're buying this below replacement excluding land because these canopies have gotten reasonably expensive to put up. Maybe $29 a rentable foot, including the land development or land improvements. So if you get cheap enough, your advantage here is, can you buy it at a low enough value that it becomes difficult to compete? Now, the caveat here is, I noticed the broker left out this owner, and again, this is just available on Google, has a second newer property in Midlothian that has a little bit lower rents than this one that they're currently leasing up. So you've got a group that appears to be pretty prolific putting these on the ground. They're a general contractor. They're building their own units. I don't know how many they're going to be building after this because of all the lease up issues and the floating rate debt or debt exposure, but that's a challenge.
How many acres?
This is about 28 acres.
So what's that? 300 grand, Brett, per acre in Midlothian, Texas, with a couple of
I drove through Waxahachie in Midlothian this weekend, so I could have gone and checked this out for us. But
how about the gravel lot? Is that a negative for this?
Yeah, it's not ideal. Kind of ironic. I think, Elliott, you mentioned before that Midlothian's the concrete capital of the world. Yeah. And they use gravel. So the drive aisles in here, I believe, are asphalt. It's not, it depends on the quality of the vehicle and what you're charging. Gravel is probably going to attract, lower level of tenant if there's, asphalt or concrete available, or wrap product of the reused asphalt. But you do have, potentially some dust issues and stuff like that.
How do you think about the, for lack of a better term, the unit mix here? Because you've got some open area, you've got some that appear to be covered, you have some that appear to be covered and also have a back wall, and it looks like there's also some maybe self-storage lockers. Is there any kind of rule of thumb for we want a mix of storage on our site that is X% open, X% covered, X like, does this look attractive to you from a unit mix standpoint, or would you make changes too?
Yeah, I think from a unit mix standpoint, so one thing that's interesting here, and I looked at this on Google Earth and measured out the drive aisles. You have incredibly large drive aisles here, like in some cases between those units, like 160 feet. And in reality, you don't need that. You could shrink that down a little bit and maybe do some outdoor storage in the middle. The question's just demand. Generally speaking, in this space, a lot of people kind of look down on the open parking stuff, but it also tends to be the most flexible. And here you've got pretty low prices for your covered parking, so you're kind of okay there. But what having more open parking allows for, and you see it on this one in the back with some of the tractor trailers, is more commercial uses, because your landscapers, your contractors, service businesses, they need a place to go as well, and they have fleets, and they're not going to pay for covered or enclosed parking.
Sure. Do you think the total number of RVs per capita in this area is going to go up or down over the next 10 years?
Yeah, I would imagine that it probably stays about the same or goes down a little bit. The thing about the RVs that's interesting, right, is you have this huge demand pull forward in 2020, 2021, maybe early 22. And the manufacturers were kind of overwhelmed. You had maybe some quality issues that I've heard about, and thought for a long time that if you ever want to buy an RV, that like 2025, 2024 is a really good time to buy one. The thing that's interesting with these deals is it's not like self-storage where you're kind of storing junk, although some of them definitely have their share of junk. But those vehicles that were bought in the last few years, they're going to end up going somewhere. The question is just, do they go in somebody's yard? And in this area, most of the new development, a lot of it seems like it's in HOAs or, communities that maybe won't allow for that. But you have a lot of land here.
Brett, are you in an HOA? Are you cut out for that life? Or are you able to do whatever you want?
You're able to do whatever you want. So I live in an older neighborhood that, again, no HOA. And so what's interesting about that is there's a lot of people that film commercials in College Park just because there's no HOAs.
And this is true commercials, not like a euphemism.
No, this is these are like real commercials. Like people get
it. Okay. I wasn't sure, man. I don't know what kind of lifestyle you're living down there.
Yeah, I've always wondered, kind of why do you keep picking College Park? And then finally somebody was like, you're an idiot, which I was like, all right, no. He's like, there's no HOAs here, so that's what we keep doing. But I think that's a good point. You've got the president of the HOA of some subdivision that's kind of takes their job very, very seriously, which is code for nothing better to do than walk around and write HOA violations to people, which is always a fun experience. And that's also code for head of the complaint department as the HOA president as well, I think.
Adam, if you're going to buy this deal, there's some stabilized yield. There's a couple of metrics you guys are targeting. There's going to be IRR. There's stabilized yield. You've got a debt yield you're keeping an eye on.
Yep.
Walk me through, okay, we think we need to cut rent by 8%.
Yeah.
And that'll let us get to 82% occupancy.
Yep.
And we trend that forward at 2.5% rent growth over the next few years. And if we do that, we are trying to hit X for a return. And that could be cash on cash and stabilized yields and IRR, like whatever the metrics are that drive it, which means we can afford to pay Y. What are X and Y? What assumptions would you make when you're buying something like this?
So I think on something like this, you've got a little bit more flexibility because you've got 7 years of term at 4.6%. Okay, on something that, yeah, you're cutting rent, but stabilization's pretty close. You're not that far away from stabilized. This thing isn't 50% occupied. Mm-hmm. I think that you're probably at a 7.5 or so, that you're probably happy with this. As a stabilized yield on realistic operating expenses and realistic occupancy and rents. The one thing that I would be a little bit concerned about here is the loan balance at 7.5 million. You start getting pretty high levered pretty quick, and not a huge fan of that.
Which is why a lot of people go the CMBS route. I know we made jokes about them being easy to work with, which is not true. And they were a big reason for the great financial crisis. Yeah. But that is why you go CMBS, is because they're going to give you more money, and you've just got to kind of, white knuckle it through it and hope there's not a single issue, because you're not getting anyone on the phone that's going to make a decision to help you out there.
Yeah. Just looking at when this was originated, I think this was a 2021 CMBS loan. I'm going to go out on a limb and say this loan was not originated at 74% loan to value.
Right.
When they got appraised.
The value erosion is kind of driven the leverage up.
Yep.
What is it worth more than the loan balance?
I think
with conventional debt, not assuming the debt. If you had to put new debt on it, is it worth more than the loan balance today?
If you had to put new debt on this, I think it's probably fairly close to the loan balance.
So maybe I missed it, Adam, in terms of like this outdoor self-storage, what's the most, I mean, all the economics or metrics are important, but is it just a pure cap rate, kind of cash on cash, levered?
Yeah, I look at the yield on cost with this, at the stabilized yield on cost.
Yeah.
Obviously cash on cash is important too, but trying to take the debt out of the equation here. I think if you were out in the market financing this with perm debt today, you'd be at least in the mid sevens. So just looking at something, where can you fall out where you're cash flow neutral or better? It's going to be a while here because you've got development, you're in the path of growth, but there's a lot of land.
Ooh. Professor, I have a question for you.
Yeah.
Because I argue about this with some regularity, because brokers will call me, not Brett. Brett does know what he's doing. I give him credit for that. But a less informed broker will call me and say, we've got this great loan assumption, and you're going to pay this sort of higher basis because of it. And I say, this is not interesting to me. You can buy this or another park. I don't know what we're calling these things, but let's assume some outdoor storage. You have two properties you can buy.
Yep.
We're adult toy storage is what we're calling
adult
these
toy
types
storage.
of properties.
You can buy this one, which has accretive debt, and your entry point is X. Or you can buy something else, similar quality, size. Let's say there's got to be another one of these in the DFW Metroplex that looks and feels similar. And you have to buy it free and clear. And because of that, you have a lower entry point. Like if you're solving for the same yield, obviously you're going to have a lower entry point to get, because your cost of capital is higher.
Yeah.
In those two scenarios, do you have a preference? Do you like having the lower basis that's driven by the higher cost of debt, knowing that you can eventually move around with that debt over time? Or do you think, look, 7 years of term?
The other way to think about it is, why on earth would you pay $3 million for a loan on in Waxahachie, Texas, on some shitty gravel lot with some tin buildings on it? The other thing I think about with this is at $10 million, like just generally, is you're relying on netting $750,000 a year of people paying you to store RVs and boats in a place with seemingly pretty few barriers to entry, as the seller is proving. The big thing to me on those is one little thing I always like to imagine is, would you want to own this land? Elliott's got the deal of why would you want to live here, or why would you want this property? And the corollary to that is, imagine this with no buildings on it. And do you want to own that land? I have slightly more than zero interest in owning that land. I mean, look at it. Describe the area for us, Brett. I think we can see cattle.
It is.
Trees,
I think it's
cows.
ex-urban. Yeah, I think the highest and best use might be tearing this whole thing down and turning it into an agricultural facility for reducing taxes. That's a big deal.
Adam, this
Texas.
must have come up with at some point.
Yeah.
When you're talking with your students, do you have a view on a slightly higher basis and below market debt versus a lower basis with what is today inflated debt? Like, how do you think about that?
Generally speaking, I'd prefer the lower basis with the inflated debt. I guess the only caveat to that would be if there's something very unique about that debt and it's got an extremely long term.
Yeah, so this feels like accretive debt long term.
Yeah.
And as long as your exit assumption is assuming that the buyer is going to have market debt and not below market debt, then you've sort of grossed up your exit cap in a way that's appropriate.
I think that's absolutely key here. And that's why I thought this one was a little bit interesting to look at on that because or on the podcast, because it's got that element of assumable debt, which makes it more saleable in this environment, which is kind of the sell what you can thing, because somebody will look at that and go, hey, there's the debt's an asset here as opposed to some of the other properties that these folks own that, they just aren't willing to part with them yet until the pain gets more acute.
You're straining for sales points, looking at the page we are now, to say that the location is local to Navarro College. So if I was thinking about where I might want to buy,
hard hitting. That's a hook.
Where I might want to buy boat and RV storage, I'm going to be looking.
All those college kids with their boats.
Yeah.
This is an SMU, which I think lots of kids have boats there. I wasn't one of them.
If you could buy this, and you're happy with a 7.5 stabilized yield, do you think that this seller, maybe you know more about their portfolio, they might have some floaters out there, they might have some deals that are in trouble, so they're trying to sell off something that they view as a more stabilized, desirable product? How many buyers of this are there right now? Like, they're asking 10.2. Could you just show up and say, here's 8.5 million?
I think there are still a handful out there. I don't know that there's certainly less than there were a couple of years ago. You get maybe 5-6 offers. Maybe more. There are groups. There are a couple big national platforms that have a good size footprint in Texas, some PE-backed groups. Given the values that some of them have paid over the last 3 years, this is a lot lower than that. I don't know how they ultimately end up making money, but there are some groups that are just trying to scale.
We talked about this last week when Eric was busy being appointed as the new Secretary of HUD. We looked at a multifamily. Yeah, also about Eric. Congrats, by the way. Big news for Eric. We talked about a multifamily project in Abilene, Texas, and there wasn't a ton of value add. So the real thought was there's not going to be also a lot of appreciation. There might be more appreciation in Midlothian than Abilene, but for me, for something like this, it doesn't sound to me like you're saying there's a big value add story here. You're not going to step in and do X, Y, Z to meet demand.
Nope.
So you're really needing to make sure that you're buying where today's rent is tomorrow's rent, or tomorrow's rent might be a little less than today's rent. And your entry point matters a ton because there's not a lot you're going to do to really improve this asset. So you have to buy it pretty defensively, like your position and believe in the cash flow. Is that how you are looking at this?
100%.
I think the value add component here would be expanding this portion of the site. To go back to a line I used in the prior, you could use this as like airboat storage or additional wet storage for boats for the college kids from Navarro that have boats.
Or you can put a
like
tiki
that
bar out there.
Yeah.
That's right.
An amenity. I like that picture a little better because you can actually see structures in it.
Yeah.
Unlike the other one where it's just fields.
One of the greatest real estate capers that I was witness to was a property down in Myrtle Beach, which is kind of the Coney Island-ish sort of place in South Carolina. And guy had built this outdoor bar restaurant environment filled with like goofy things like left-handed stores and kite stores and I think Hootersy kind of places. Lots of on a boardwalk above a swamp. And so first of all, it was a great location in the middle of the strip, but nobody could figure out what to do with it. He went in and put pilings back when you could just do this on wetlands, and built an elevated boardwalk with all these goofy stores and places to drink beer for sunburned families. And what he was finding was that kids were chucking the food out into the swamp, and the alligators would come up and eat it, and it was great entertainment. And being the enterprising real estate tour, he goes out and buys like 30 of those gumball machines, fills them with dog food pellets, and put signs up everywhere that says respect the wildlife, do not use restaurant food, only this pre-approved whatever. And so so kids, it provided this form of entertainment where drunk dad could then hand out quarters for these kids to go get a handful of dog pellets and chuck them into the swamp and watch what happened. Anyway, this cat was making $400,000 a year in quarters on selling stuff. So all that to be said, we've got a little bit of a wet spot back here in the back corner of the Midlothian boat storage. There might be
add alligators.
There might be something to do here.
Yeah, you could import gators. It'd be gators as a service.
See, this is the value add that I'm talking about. You're not.
We eventually would.
Right.
I'd love you to pitch this to the city of Midlothian. We're going to bring some gators in, put a tiki bar.
You could do a little patio in the back corner there.
Yes. See, now this
tacos and beer.
This is how you blow the thing open right here. Right here.
Right.
Texas Disneyland.
You've got another pond over here. You can maybe stock.
That's right. And then you start linking them together. Next thing you know, it's a Great Wolf Lodge.
Yeah, this sounds good. We've got a winner. This is the boat.
I was a hell no on this deal, but now I'm getting the closing bell out, the buy bell out.
Awesome. Well,
I think so it would just be, instead of the drunk dads of Myrtle Beach, this would just be drunk college kids until one of them fell in there and the alligator ate them.
Yeah.
This is Navarro College entertainment right here.
Yeah, it is.
Right. They might add that to their marketing brochure.
See?
I went to an insane place in Thailand that sold buckets of raw chicken that you could feed the gators. And that was a ton of fun.
That's what they do at Gatorland.
I really can't believe.
I think is the OG theme park.
It's hard to believe that this sort of insight's not being charged for. This podcast is free.
Yeah. If
really
property owners listening,
there's got to be a paywall or something.
Why let somebody else have the upside?
Yeah, right. We need to change this from Real Estate Anonymous to Hidden Alpha and charge people.
Yeah,
for this kind of insight.
Well, or just get part of the mish from these brokers.
Yeah,
I mean, this is how you're going to move this property. No, there's not one page in here referencing alligators. Not one goddamn page.
This is a real mess.
It kind of reminds me of the Mad Men meme where he's standing in front of the whiteboard. Gators.
Gators.
Yeah, so I think in the investment highlights here, alligators and needs to be prominently highlighted versus some of this by the book, textbook academic stuff here.
Boy, if an analyst on our team brought this to committee with the alligator pitch, I think they get promoted in a heartbeat.
Yeah,
you got to admire that kind of gumption.
I do have. I think I've shared on a prior episode. I had the fortunate opportunity to go to our office in Hyderabad, India, which was a great experience, and it is just interesting, kind of hearing some of the questions that came up, and one of which was this gentleman didn't feel comfortable asking this in front of the group that we were presenting to, but came up to me afterwards and said, "But you're in Florida, so do properties trade at a discount because there's so many alligators there?" Which is kind of, that's not poking fun at anyone, but like that is kind of an interesting question. And I said, no,
this
people
doesn't
pay more
reference
for
that.
beachfront.
It should say alligator free. Like there's not.
Dude, I'd rather deal with the alligators than most of the people in Florida.
Yeah, there's more. I said, no, beachfront property is the most desirable. And if you flew a drone over any beach in Florida, there's 300 sharks within a mile of wherever you're swimming. But, I would say if your day comes up and it's via an alligator attack or a shark attack, that's a great way to go. Yeah. Like Frank Drebin in Naked Gun, I think he said, getting caught in the gears of a combine, parachute, I'm not opening. That's how I want to go. So, I mean, what's the sense in just going out like kind of like everybody else? Like, go out in a blaze of glory.
Yeah.
All right. Well, I think we've reached the logical stopping point. So let's find out: are we buyers at some reasonable number above the loan balance where this might trade? Eric? No, huh? Brett?
Not. My offer would be contingent on the alligator permit, but
okay.
I don't
Gator
think they love my price.
Mm-hmm. Adam, you a buyer here?
I'm a buyer at the right price. I think you can operate this at the right price and be in a good position as new homes come in. But the key is at the right price.
I'm inclined to agree with you on the at the right price.
The University of Florida Gators got whooped down in Austin this weekend, which I went to that game. They could have just sent the Florida Gators up here to maybe come in and at least check that box.
Yeah, improve curb appeal.
I don't know if they would eat dog food that would be thrown at them. I would assume they get fed a lot better than that.
All right. Well, we're not really ringing the deal bell. We've got a split decision in the house here. But this was fun, gents. Anything else?
No. That's it. Thank you.
Adam,
thank you very much, Adam, for joining this week.
Thanks for having me, guys. Appreciate it.
Thanks, Adam.
Yep.